Hey guys, Sensei here. If you saw my last video, I was discussing or relating the obstacles and stressors that we have in life to having to push a tire up to the peak of our own mountain. And we all have our own mountains to climb. And in this situation, I'm going to go ahead and jump ahead and assume that you have an income stream coming in at this point. And when you have an income stream, there are those invisible forces that are always there that are going to be pushing you essentially back down toward poverty if you don't make the proper decisions and make the calculated risks. And the first one are bills, right? If you're overextended on your bills, if let's say you buy a really fancy car when you're young versus maybe having the car that just got you around until you were able to accrue better wealth to afford the nicer car, but that's up to you. That's a part of your life, right? But knowing that having too many bills, whether you have too many streaming services, whatever the case may be, your bills can overextend you and push you back towards poverty. So always try to get a handle of that. I have, I'll put it in the description as well. It's called Undebted. It's a free calculator. You plug in all your credit cards and your loans, and you do what you can to get out of debt as quickly as possible. So that way you can start focusing on your plan A. So the next invisible force is inflation, right? Inflation, it's a monetary policy that can affect us. And as I'm making this video, the Fed has actually increased interest rates, which is in effect going to affect the supply and demand across the world, which actually can shift the valuation of our dollars that we're creating over the years. So it's important to just factor in the fact that invisible force of inflation can push us back towards poverty. And then, of course, the next thing is taxes, right? If we just ask anybody who's been audited by the IRS whether or not they wish they would have paid their taxes properly or, try not to avoid them because what happens? You go to jail, right? So we need to pay our taxes or be savvy on how we pay our taxes, right? I believe in paying taxes, but not paying more taxes than you need to, right? So it's important to understand how taxes will affect whatever plan A that you're shooting for. So keep in mind, these invisible forces are always going to be there. You're not going to see them, but they're always trying to push you back towards poverty. So the goal, again, the real quick recap of the last video, is to live in a degree of comfort. And that means that you have something set aside for about 4 to 6 months. This is money that you don't touch. You don't take a person out on a date with it. You don't take a plane trip to go see someone with it. An emergency fund is exactly what that's for. It's for in the event you lose your income stream, that is, protecting you and your family, paying the cost of living. You have this money to tap into. That way you can look for your next hustle and come from a position of strength versus a position of weakness. So having getting that emergency fund is paramount. Once you have established an emergency fund, our goal is to next work on being above average, which is having a plan A. And I don't know what your plan A is. Everybody has a different plan A. I have an opinion for what a plan A should be for all people, but that's my opinion, and I'll delve more into what I mean by that in a bit. But in my opinion, all plan A's should have grit. They should have teeth. They should be well grounded. They should be immovable, so that you don't slide back towards poverty. That's why you want to make sure that you're positioning yourself so that it's not on quicksand, right? You want concrete. You want something that's got guarantees, right? You want things that are in place so that you, in the event that something really bad happens, that you're taken care of, and that's what your plan A should do. Now, all plan A's are based on simple interest and compounding interest. So, if you need a real quick recap of how the simple interest and compounding interest works, I know many of you already know what it is, but oftentimes you just need to see the power of it in your face. I made a real quick video about that. You can look for that. But essentially, compounding interest is key because whether it be through passive income, whether it be through some sort of investment vehicle, whatever the case, you're essentially having your money work for you versus having to go out there, My dad used to call it, mouth to table, right? Or table to mouth, whatever that was. Essentially, you want to have your money working for you. So compounding interest is going to be established within your plan. Your simple interest and compounding interest is going to be within your plan A. So let's talk about those things that can push you down the mountain as you're deciding on whatever your plan A is going to be. Remember, there are, if you have too many bills, that can knock you back towards poverty. Inflation, that also knocks you back towards poverty. But taxes, that can knock you back towards poverty. So at least understand the path of how you're going to pay taxes when you're using your plan A. Okay, so let's look at that. And I like to simplify things. I like to call this the tax me now bucket. Okay, so this is, essentially, you're going to pay either quarterly or annually your taxes on this type of plan A. The next is the tax me later bucket, which is essentially, taxes that you're going to pay later down the road. You don't pay anything up front, but you pay taxes later. And then I like to call my favorite bucket, and this is what I call the slightly taxed bucket, and I'll delve into why I call it slightly taxed in a bit. Now let's kind of touch base of what are some of these tax me now plan A's out there. Well, we all really kind of know what they are. If you have money in a savings account, a CDs, if you own stocks or mutual funds, real estate, these are all taxed either quarterly or annually. You're going to pay taxes on any growth interest from those accounts or those stocks or mutual funds. Now, I underline bonds because there's different kinds of bonds out there. Municipal bonds are federally tax-free, and generally, depending on the state that you live in, they're also tax-free. But I underline them because there's also types of bonds that, if you cash them out too early and having to do with the maturity time frame or how you transfer them, it also can wreak havoc on the taxes of those. You have exchange traded funds and your REITs and your business. These are all essentially taxed, either quarterly or annually. Okay. Then we have the tax me later bucket, and these are what we call your qualified plans, your IRAs, your 401ks, your 403bs, your SEPs, specials, simples, college 529 plans, and annuities. And there's other qualified retirement accounts out there. And so these are I always like to give the analogy, if you're a farmer, you have seeds in your hand, and then you plant them across this crop, and then you're not paying any taxes yet. And then when you're ready to harvest your crop, that's when you pay the tax man. Okay, so that's kind of the way those vehicles work. And then I have my favorite, the slightly taxed bucket. And the reason why I call it slightly taxed is because rather than, if you're the same farmer, if you have a handful of seeds, wouldn't you rather pay taxes on the seeds than plant your crops and then allow it to grow and then harvest and not have to pay any taxes because you already did on the seeds, right? So I'll dive more into that in just a bit. We all know essentially how the tax me now buckets like. We all know what it's like being taxed annually or quarterly. I won't delve into more of that. If you want to talk to a CPA or a tax professional, I always recommend doing that. I am not one of those. So, and if you happen to be a tax professional and I do something incorrectly, please, leave me a little message and I'll do what I can to clarify and make some changes. But this is based on what I've read and how I see things. And then there's the slightly taxed. I'm going to get more in depth into how that works. But which leaves me with the tax me later bucket. Let's go ahead and delve into how taxes can work if that's your plan A. And let's go ahead and let's look at, say, a 401k, because so many of us have them. How does a 401k work? Well, let's say you're working for a company for about a year and they offer a 401k. And what essentially is going to happen is they're going to take pre-tax dollars and you're going to start funding this thing. Now, right now in 2022, the maximum contribution is $20,500, and oftentimes the employers will match up to 3.5% of an annual salary. So people like this vehicle because they're getting free money from their employer. But as you'll see later on down the road, how this can still affect you when it's time to withdraw these funds. And I'll talk about that in a bit. But if you're aged over 50, you can have an additional catch-up funding of $6,500. Okay, so this is all pre-tax dollars. Okay, so then we have the accumulation phase. This is like, how does this thing make money now? So you collectively, both you and your employer are putting money into this investment vehicle. And it's essentially put into an investment fund, which could be, mutual funds essentially made up of stocks and bonds. And that's directly tied to the market and all of its volatility. So if the market goes up, you can get some gains. If the market goes down, you can lose. You can ask anybody right now how their 401k is doing in the year 2022 with regards to the volatility of the market. And you're probably going to get a frown, a big, big frown. So anyway, they still like it because their employers are putting money into it. So that's essentially how that aspect of the 401k works. Now you're putting money into this thing with the assumption that later on you're going to be able to withdraw from it, right? So later in life, which makes sense because later in life we're not as healthy. We're a little bit more, maybe less agile, maybe more senile, right? So you want to be able to tap into some sort of nest egg to withdraw from. So these are the rules with regards to how a 401k works with regards to the IRS rules. Now, again, you've been funding this thing with pre-tax dollars, okay? And so once you're ready to withdraw, you're going to start paying the tax man. Now, these taxes are going to be based on your current tax bracket at the time of withdrawal. So if you're sitting down with anybody and they say, well, you're going to be in a higher tax bracket or a lower tax bracket, my recommendation is to get up and walk away from that person because no one can foresee what tax bracket you're going to be in 20 years from now if you're a younger person, okay? So keep in mind your taxes are going to be taken out once you start these withdrawals. Now, you can't just take out money anytime you want with these vehicles. The first rule is the age 59 and a half rule, which states that if you take out any money from this vehicle, which you haven't been paying any taxes on, before the age of 59 and a half, there's a 10% additional tax penalty. So let's say you're in the 33 percentile tax bracket and you're 58 years of age and you want to pull some money out of your 401k, well, you're going to have that 33% tax bracket plus the additional 10% penalty tied on to the amount of money that you're pulling out. Okay, so that's how that works, right? That's nice. And then you have the 70, I'm being sarcastic. Then you have the 70 and a half year rule, which says that, you know what, hey, you've been funding this thing all these years, and maybe you like the way it's been growing over time, and you just don't want to touch it. Let's say that maybe you have other income streams. You can say, I don't want to take any distributions from my account because I like the way it's growing. Well, surprise, the government says, listen, you've been funding this thing for so many years. We haven't gotten any tax dollars from it. You're required to take a minimum distribution from this account. And if you don't take that minimum distribution account, we're going to go ahead and it's almost like garnishing a 50% penalty of the required distribution. So let's say you've built up a pretty nice nest egg and they require you to take $50,000 out. Well, even if you don't take out that $50,000 from the account, they're going to go ahead and just take $25,000 or 50% of that $50,000 right out as taxable monies. Whew, so that's how that works, right? So then we have to look at, well, how is it transferred? This is called estate planning, or a nice way of saying what happens when you die. So upon death, your funds become part of your taxable estate, and the funds will be distributed to your spouse or whoever you tied as your beneficiary, and they will pay income tax on those funds and any estate taxes that are owed. So always contact a tax professional because they might have some different strategies on how to spread out those tax burdens, and they have different strategies. So it's always good to talk to a CPA or a tax professional to make sure you're doing that properly. Okay, so that's how your 401k works, right? So the nice thing is that your employer puts money into it, you get money in it. It's the bad thing, it's tied to the volatility of the market. So it's great if you're winning, but it's terrible if you're losing. And then there's all those rules regarding its withdrawals. Okay, so that's how that works, which leads me to my favorite, the slightly taxed. right? And there's only a couple of them. There's a Roth IRA and a cash value life insurance policy. And I know now the thing of it is let's just go ahead and dive into what a Roth IRA does with regards to the IRS rules. So with a Roth IRA, it's funded with after-tax dollars. So this is what I mean by slightly taxed, because now you're the farmer who says, okay, I have all of these seeds. Why don't we just pay taxes on all these seeds? And now I'm going to put the crop out there and I'm going to allow it to grow over the years. And then I'm going to harvest and I'm going to keep all that money. Okay. Why? Because you already paid taxes on the seeds. So this is what I mean by slightly taxed. You paid taxes on the seeds. So your Roth IRA is funded with after-tax dollars. It accrues interest tax-free. That's nice. And the withdrawals are tax-free up to the basis, not your earnings. So anything beyond the growth that was tied to the market the interest that accrued will be taxed beyond the basis or amount that you've put in, because you've already paid that in your with your after-tax dollars, and then you allowed it to grow. And you're going to, any growth beyond your basis, you're going to be taxed. So in addition, with your Roth IRA, you also have the 59.5-year rule, which means that you can't take it out before age 59.5 without a penalty. And also have the 70.5 rule, which is the required minimum distribution rule, which says that, if you don't take that money out by age 70.5, they will give you a 50% penalty. And in addition to that, the account has to be open for 5 years. So let's say you're getting a little bit late in the game, you don't start your Roth IRA till age, say, 58, you won't be able to actually tap into those funds until 5 years later, despite the 59.5-year rule. Okay, so here's the great thing. You're like, oh, okay, well, I got after-tax dollars, I got interest tax-free accruement, and the withdrawals are tax-free. That's great. But here's the thing about the Roth IRA. There are eligibility requirements based on your income. So if you make too much money, right now, if you're in the year 2022, your modified adjusted gross income must be less than $144,000. If you make more than that, you can't start a Roth IRA. In addition, if you're married and file jointly, collectively, your household can't make more than $214,000. If you do, you cannot start a Roth IRA. And in addition to that, let's say that you start a Roth IRA in your younger years and you're not making quite $144,000. And then say 5 years later or 10 years later, you start making more than $144,000. Well, at that point, you can no longer fund your Roth IRA. You can still hang on to it and tap into it within those rules and regulations of the 59.5-year rule, but you can no longer fund it. Okay, same thing as if you were married. And if you're under the age of 50, there are contribution limits. So you can't actually fund it however you want. You can only put in $6,000 if you're under age 50 annually. Okay, and if you're over 50, they'll allow you the contribution limits to be $7,000 annually. Okay, so that's as much as you can actually fund this vehicle. And in addition, the contribution limits are associated with all IRA the Roth or the IRA's accounts in your household. So let's say you have one and your spouse has one. Collectively, you can't put more than the $6,000 annually if you're under 50, or the $7,000 if you're over 50. So collectively, both IRAs combined can't do more than that. Okay. Okay, so it's still a pretty good vehicle if you meet all the criteria for being able to start a Roth IRA, okay? Which leaves me to my favorite, which is cash value life insurance. And I know many people, when they hear that, they think, cash life insurance. Here's the thing. When it comes to cash value life insurance, it's important to realize that many bankers and many very smart and savvy people have tarnished the way the cash value life insurance is, because it takes away from what they do. So just keep that in mind, because cash value life insurance has been around for close to 200 years. And I got to say, these companies have been around and they know what they're doing. They got a strong history of knowing what they're doing. And in addition to that, here's the reality. When we look back to the Great Depression and we look at how people were in soup lines and people are going to the banks and trying to get money out, and the banks wouldn't even let them pull out their own money. it wasn't the banks, or wasn't our U.S. government that bailed out the banks. Many people think that. Who do you think it was? That's right, it was the insurance industry. Do you know that there are over 2,000 life insurance companies throughout this country, and collectively they own more, control, and manage more assets than all of the world's banks combined? Yeah. So what does that mean? That means that there's some serious financial clout to all policyholders. Okay, so keep that in mind. It's the backbone of this country. So anyway, I'm sorry, I just got off track there. But let's go ahead and talk about the advantage, the slightly taxed aspects of cash value life insurance. So just like your Roth IRA, it's also funded with after-tax dollars. It accrues interest tax-free. Withdrawals are tax-free up to premiums paid into the policy, okay? And that's excluding loans. I'll talk to you more about that in a bit, maybe in my next video. And there are no age rules regarding with the withdrawals. There's no 59.5 rule. There's no 70.5 rule. There are no contribution limits beyond the corridor. And what does that mean? That means that there's some legislation known as TEFRA, DEFRA, and TAMRA that essentially regulated life insurance policies and saying that if you're going to fund a life insurance policy, it has to be funded in a way that it remains a life insurance policy, which is a great thing because of all the benefits when you have a cash value life insurance policy and all the benefits, the living and death benefits associated with that. But they're making sure that it's funded in a way that it's not turned into what is called a modified endowment contract, or a MEC, because at that point, it then becomes like these other qualified plans and it's taxed in the same way. So you want to be smart and savvy, making sure that you're talking to a qualified person who knows how to strategize and create one of these policies properly for you. But essentially, once you set this thing up, there aren't contribution limits of, say, $6,000 or $7,000. You're not going to have any of that, okay? There are also a guaranteed tax-free death benefit. Now, you can't say that about all these other qualified plans. If you pass away, it becomes a part of your estate with those other qualified plans. With the cash value life insurance policy, you get a guaranteed tax-free death benefit. Okay? There is guaranteed interest growth inside your policies. Okay? And you can't say guaranteed about anything with those other vehicles. There's guaranteed tax-free access. There is guaranteed level premiums. And that also goes into the type of life insurance that you're getting. And I'll do it, like I said, I'll do another video on the different types of life insurance. And then it is also creditor protected unless it's a part of your estate. So if, let's say that you're getting sued and you have a life insurance policy, well, that lawyer can't tap in to the cash values of your life insurance policy and break it up and get at whatever's in there, because that would be illegal. There's laws against that because you're now taking away from that person taking care of their family. So there's a lot of laws against that, and it's creditor protected. So just based on those things alone, you can see the power of cash value life insurance. So here's the big kicker. You got to be healthy. So those other things, you have all those contribution limits. You have your income limits and things like that. You don't have any of that with cash value life insurance, but you have to be healthy. Okay, if you have type 2 diabetes and you're insulin dependent, let's be real. These are insurance companies. They're in the business of making money alongside you. That's what they want to do. They want to partner with you so that you make money and they make money. And if you're too high risk and you're closer to death, quite honestly, you're gonna actually be a liability to them versus an asset. And it's as simple as that. So I don't make the rules, I don't make the regulations, but you have to be healthy. If you're insulin dependent, or you've developed cancer, if you waited too long to get a life insurance policy, you won't be able to get one on yourself. But the great thing is if you can be the owner of a policy and it can be on someone else, and you can still get a lot of the great living benefits of the life insurance policy. So there's a lot of cool things that you can do. I'll talk more in depth about that in a bit. I hope that this video has been enjoyable for you and give you some understanding of how taxes work with regards to whatever plan A you decide. Whatever plan A you decide, you want to make sure that you understand how the taxes are going to work and how it can be pushing you towards poverty if you're not making the right decisions and looking at risk in the proper way. Okay, so thank you and look forward to my next video, and I'll be diving into life insurance in general and the different types of life insurance, and I'll see you then. Okay, take care. Oh hey, almost forgot. If you like this information, please like and subscribe. I'll be seeing you on the next video. Take care.